Hey guys, Bix Weir, roadroad.com. Let's talk about whether or not the world can shut down for a few months and then just everything goes back to normal. Can, in today's day and age of financial complexity, shall we call it, market rigging, uh, extremely complex relationships with the derivatives on both sides of the trade, on all sides of the trade, if there's three or more parties, the system cannot shut down and just start up again. And we're going to see that very soon. Although market rigging is alive and well from Steve Mnuchin, who believes he's going to get his $5 trillion to do about a month's worth of market rigging. So he is bumping it up today, up 1,200 points on top of yesterday's 2,000 points. 100% derivative market rigging from the Exchange Stabilization Fund. That's all it is. That's all our markets have been for decades. 100% market rigging. It doesn't matter what happens in the real world. You're always going to go up, and then they're going to slam it down when reality kicks in, and then you're going to go up again. Now, the derivative problem is a new problem. They were able to gloss it over with $29 trillion in 2008, but they only did it for 10 years. That's all they had. They threw everything at it, and it lasted for 10 years. And that debt is still there. Everything's still there. It's just bigger now. And we're seeing problems all over the place. But for the last 3 days, we see what Steve Mnuchin has done. How hard is it? Click, click. I want the market to go up 1,000 points. Click. Unlimited derivatives. Doesn't matter. Doesn't matter just that the world is shut down. Every single business on planet Earth needs a bankruptcy bailout. And every day that it goes on is 100 times worse. The latest $2 trillion add to the system does nothing. It does nothing to a multi-quadrillion dollar complex system that needs continual money flow. What was it? Jamie Dimon said $5 trillion goes out of his Florida money office every single day. You have to have continual money flow to keep the con going. So now the music has stopped and nobody knows what chair they're sitting in. And multiple people are trying to sit in the same chair, so the Fed is buying every chair they can. So yes, they can place the stock market wherever they want. Interesting thing going on in the bond market, though, after the Fed said they're going to bail out investment grade bonds, the yield on the non-investment grade is going crazy, over 10%. Bond market tears in two. Distressed debt is cratering as Fed buying of investment grade sends LQD NAV soaring. Just last Friday, we reported that a number of distressed debt in the U.S., roughly defined as bonds with a spread over 10%, had soared, doubling in just 2 weeks to a remarkable $500 billion. Well, it doubled again. According to Bloomberg's James Cromie, there is now about $1 trillion of debt trading at distressed levels after this month's credit rout. And it's rising fast because as the impact of the severe economic slump, which as noted earlier includes nearly 50,000 shuttered retail locations, and surging funding becomes clear, credit spreads are set to spiral higher. Specifically, the number of distressed bonds neared 1,900 this week, just shy of the record 2,000 hit during the financial crisis of 2018. You cannot shut companies down for 2 or 3 months and expect them to just jump up and start working again. They have to fire their employees. They have to get rid of all their fixed costs. They own all these stores that aren't even open. They will be bleeding money profusely for days, weeks, months, and if they survive, years. So when you look at this, when Steve Mnuchin rigs the market up 3,000 points in the last couple of days, you're going, in what world does the stock market go up when every single business on planet Earth is shut down? In the world of make-believe, in the world of Steve Mnuchin's computer model rigging. Putting this surge into context, just 3 weeks ago, the start of March, there was less than 300 distressed issues. The rout is to be expected as the spread on the entire junk bond index flipped above 1,000 basis points on Friday, and strategists from JPM and other banks expect it to surpass 1,200 basis points soon, leading to a surge in defaults. We're coming to that surge in defaults. In a report published last Friday by Bank of America, its credit analyst Oleg Melitev said, quote, "We think this credit cycle has turned and expecting default rates to rise meaningfully in the coming months." Duh, nobody's open for business. Fixed costs keep coming in. Revenue is zero. How long can a business survive on that? Most businesses today, not a month. Definitely not 2 months. And we're looking at probably 2 months. At least, well, Trump says at least until Easter, which is 3 weeks. So that'd be put it at least a full month for most places. Are people going to stand for it? Are you feeling a little stir crazy right now? I am. I think everybody should be. We got to get outside. We got to move on. I don't think it's going to last 3 weeks. I think people say, fuck this. I am belly up, broke. I'm going out there. I don't care what the government says. And that's when the problem comes. And the government starts putting on the draconian measures to keep you inside to make sure that your business dies. And that's when we fight for freedom. Do not let the government take over our lives. And yes, I get it. The more people are out, the more people are going to die. What are you going to do? Sacrifice your entire life on the risk of you dying or someone you know dying? Sometimes, yeah. I don't know what the answer is. But it's going to get really ugly with the corona thing over the next month. Like Italy type ugly, where they're going to lock everybody in. And no one will be making money. All the fixed costs continue unless you default. And that's what we're seeing going on in the bond market right now. Only a week ago, we summarized all key leading indicators of credit stress in a table below where we compared the current level on each of them to the point in time closest to it going to the two previous cycles, marking April 2001 and September 2008 as the points of no return corresponding to the 100 basis points level. On the HY index, we argued that the whole collection of indicators was about 3 to 4 months away from such a threshold where a turn in the cycle becomes inevitable and reversible and irreversible. B of A's conclusion, quote, "As things continue to move at lightning speed over the past several days, those same indicators are now averaging only 1.5 to 2 months of cushion before they reach such a point. Based on those timelines, today's market environment is equivalent to February 2001 or July 2008. Now that's assuming. That is assuming everything gets up and going again today. Nothing is going to get up and going today. And nothing is going to get up and going. That 1.5 to 2 months cushion is going to turn into 1.5 weeks to 2 weeks cushion. Because nothing is running. All the fixed costs are still there. And the banks rely on that. Landlords rely on getting paid rent. Everybody relies on the system functioning. Once it stops functioning, good night. No company can stay in business. But wait, it gets worse. As Bloomberg notes, there's a whole world of grief in the $1 trillion leveraged loan market. Here we go. The leveraged loan, banks borrowing many times what they have to place leverage bets. And when it goes up, they make many times more. When it comes down, they lose everything and more than what they had, which is trading an average of 80 cents on the dollar, a level typically associated with distress. Indicatively far worse than the loan sell-offs of late 2015 and the fourth quarter bear market. Leveraged loans have another 15 points to drop before they catch down to the financial crisis levels. I expect that to happen this week. Remember, Friday is the end of the month. End of the first quarter. Everybody has to mark their books to market. Holy crap. Everybody's going to be bankrupt. They're going to have to stop. Have no reporting for the first quarter. Watch for it. Regulators will come out and say, no, companies don't have to report for the first quarter. Why? Because they break all their covenants on their loans, everything would come due. There is no getting out. We are in a tailspin with no way out. And every time you look at this, think of Steve Mnuchin clicking his mouse, clicking his mouse, clicking his mouse. That's all he does. That's all he knows how to do. That's all they hired him to do. The head of computer market rigging from Goldman Sachs was hired to rig the stock market, the bond market, and keep a hold of the crypto market and the gold and silver markets. We already know, Chris Giancarlo already told us that the Trump administration, Steve Mnuchin was the head of the Treasury, popped the Bitcoin bubble in 2017 on purpose to destroy everything you crypto people had. You want to be angry at someone? Be angry at Trump, Mnuchin, Chris Giancarlo, and the other band of criminals. Jerome Powell. They did it on purpose, and they will continue to do it on purpose until they're thrown out on their ear, and this is a sign that they are going down. The bond market's going crazy, and the derivative market is at all-time highs. Look at gold and foreign exchange. Look at those numbers. Amazing numbers. Huge numbers. Oh, speaking of silver, look what's gone on in silver in 2014, 15, 16, 17, 18. Nothing but up on the derivative side to keep a hold of the price. Silver is the bank killer. Remember that. And let's just look and see where these big banks are right now. Here we have it. JP Morgan Chase, $55 trillion in derivatives. Why? Why? The total assets they have on their books is 2.3 trillion. And yet they have 55 trillion in assets in derivatives. 55 trillion. Let me say it again. 55 trillion. The number's so outrageous that who knows what the hell's going on there. What kind of monkey wrench does it take to put into that market? Just the top 25 commercial banks have $200 trillion, right down here, $200 trillion of derivatives outstanding, with counterparties failing left and right. It's an accident waiting to happen. $200 trillion. The bond market is going to, a lot of that's invested in bonds and derivatives on bonds. And there's winners and there's losers. But when the losers get too big and they're a failure to deliver, failure to live up to their promise, all of a sudden the winners turn into losers too. And then you have this thing called notional derivatives going real time. So those $55 trillion in derivatives are going to go real time for JP Morgan. Good night, Jamie. Wish I could say I'm sad to see you go, but I'm not. Keep an eye on this, the bond market. Keep an eye on the Dow. Steve Mnuchin clicking his mouse. This is the end game. Do you want to know what day it's going to end? I do have thoughts on that. Go to Road to Ruta, the private road. I have a timeline. I basically go out the next 4 months. I couldn't go any farther because I couldn't see what would happen next. Because there is no way out. Everything is shut down. All bonds are going to zero. Everything's going to crash. Good luck out there. It's Bix. Talk to you later.